Hey there, welcome to Tech World GBA, your go-to channel for all things tech. If you love staying updated with the latest in technology, gadgets, and tutorials, you're in the right place. Hey everyone, welcome back to the channel. Today we're diving into the world of investing with a comprehensive look at mutual funds. Whether you're just starting out on your investment journey or you're looking to brush up on the basics, this video is your one-stop shop for all things mutual funds. We'll be covering everything from what they are and how they work to choosing the right ones for your portfolio and maximizing your returns. Investing can seem intimidating, but it doesn't have to be. By the end of this video, you'll have the knowledge and confidence to start investing in mutual funds like a pro. So grab your notebooks, buckle up, and let's get started. Let's start with the basics. What exactly a mutual fund? A mutual fund is like a basket that holds a variety of investments like stocks and bonds. It pools money from multiple investors and invests in a diversified portfolio. This spreads your risk across a wider range of assets. Let's break down mutual funds. Investing in a mutual fund means buying shares of a diversified portfolio. Each share represents a small piece of ownership. Think of it like owning a slice of a giant pizza. The pizza is the portfolio and your slice is your share. As the portfolio's value rises, so does your share. But it can also go down if the market drops. Diversification helps mitigate some of the risk. Just like there are different types of pizzas with different toppings, there are also different types of mutual funds that cater to different investment goals and risk tolerances. Some mutual funds focus on specific sectors like technology or healthcare, while others invest in a broader range of industries. There are also mutual funds that focus on different asset classes such as stocks, bonds, or real estate. Some funds aim for growth and invest in companies with high potential for future earnings, while others prioritize income and invest in more established companies that pay dividends. Understanding the different types of mutual funds available is crucial for choosing the right ones that align with your individual investment goals and risk tolerance. We'll cover this in more detail later in the video, so stay tuned. Now that we've covered the basics of what mutual funds are, let's dive into how they actually work. One of the key players in the world of mutual funds is the fund manager. These are the financial professionals responsible for making investment decisions for the fund. Think of them as the chefs who carefully select the ingredients and craft the perfect recipe for your investment pizza. They research and analyze different investment opportunities, decide which assets to buy and sell, and manage the overall portfolio to try to achieve the fund's investment objectives. Fund managers typically have years of experience and expertise in the financial markets, and they use their knowledge to make informed investment decisions on behalf of the fund's investors. They also monitor the performance of the fund's investments and make adjustments as needed to ensure that the portfolio remains aligned with its investment objectives. When you invest in a mutual fund, you'll come across two important terms: net asset value, or NAV, and expense ratio. The NAV represents the per-share value of the mutual fund's assets. It's calculated by subtracting the fund's liabilities from its assets and then dividing that number by the total number of shares outstanding. The expense ratio, on the other hand, is a measure of the annual cost of owning a mutual fund. It covers the fund's operating expenses such as management fees, administrative costs, and marketing expenses. The expense ratio is expressed as a percentage of the fund's assets. For example, if a mutual fund has an expense ratio of 1%, this means that for every $1,000 you invest, $10 will be deducted annually to cover the fund's expenses. It's important to pay attention to expense ratios because they can eat into your returns over time. Now let's talk about how you actually earn returns from investing in mutual funds. There are primarily three ways this can happen. First, as the value of the underlying investments in the mutual fund's portfolio increases, so does the NAV of the fund. If you sell your shares at a higher NAV than you purchased them for, you'll make a profit. Second, some mutual funds pay out dividends to their shareholders. These dividends represent a portion of the income generated by the fund's investments, such as dividends from stocks or interest payments from bonds. Finally, some mutual funds distribute capital gains to their shareholders. Capital gains occur when the fund sells an investment for a higher price than it originally paid for it. These gains are then distributed among the fund's shareholders. It's important to note that dividends and capital gains distributions are not guaranteed and can fluctuate depending on the performance of the fund's investments. All right, so you understand what mutual funds are and how they work? Now comes the exciting part, choosing the funds that align with your financial goals. And trust me, this is where things can get overwhelming with the thousands of mutual funds out there. But don't worry, I got you. The first step is to define your investment goals. Are you saving for retirement, a down payment on a house, or your kids' education? Each goal comes with a different time horizon and risk tolerance. For instance, if you're young and saving for retirement, you have time to ride out market fluctuations, so you can afford to take on more risk with potentially higher growth funds. On the other hand, if you're nearing retirement, you'll want to prioritize capital preservation and opt for more conservative funds. Remember, investing is a marathon, not a sprint. It's about aligning your investments with your individual goals and risk appetite. The next crucial step is to understand your risk tolerance. This refers to your capacity to withstand potential losses in your investments. Some people are comfortable with high-risk, high-reward investments, while others prefer a more conservative approach. There's no right or wrong answer here. It all depends on your financial situation, investment timeline, and emotional comfort level. For example, a younger investor with a longer time horizon might be more comfortable with growth-oriented funds, even if they come with higher volatility. Conversely, someone closer to retirement might prefer more stable income-generating funds, even if the potential returns are lower. Remember, the key is to invest in a way that allows you to sleep soundly at night. Once you've defined your goals and risk tolerance, it's time to dive into the exciting world of mutual fund research. Don't worry, this doesn't have to be complicated. Start by using reputable online platforms like Morningstar, Yahoo Finance, or even your brokerage account to screen and compare different funds. Look at key metrics like historical performance, expense ratios, portfolio holdings, and fund manager track records. Remember, past performance is not indicative of future results, but it can give you an idea of how the fund has performed in different market conditions. Pay close attention to the expense ratios, as even a small difference in fees can significantly impact your returns over the long term. And always remember to diversify your investments across different asset classes and sectors to mitigate risks. Now let's talk about timing the market. Should you try to buy low and sell high? Honestly, it's incredibly difficult, even for seasoned investors. The market is notoriously unpredictable, and trying to time it perfectly can often lead to more losses than gains. Remember, even if you correctly predict a dip, you also need to predict when the market will recover. Missing even a small part of the upswing can significantly impact your returns. It's like trying to catch a falling knife. You might get lucky, but it's incredibly risky. Instead of trying to time the market, a more effective strategy is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market's current performance. By doing this, you buy more shares when prices are low and fewer shares when prices are high, averaging out your purchase price over time. It's a less stressful and more consistent approach to investing in mutual funds. Now you might be wondering, what about lump sum investing? If I have a large sum of money to invest, shouldn't I just put it all in at once? Well, historically, lump sum investing has actually outperformed dollar cost averaging in terms of overall returns. This is because markets tend to go up over the long term, and the sooner your money is invested, the more time it has to grow. However, lump sum investing comes with its own set of risks. If the market experiences a significant downturn immediately after you invest, it can take a while for your portfolio to recover. This can be emotionally challenging, especially for new investors. So it's crucial to consider your own risk tolerance and investment timeline when deciding between lump sum and dollar cost averaging. It's also crucial to consider the overall market conditions when buying or selling mutual funds. Are interest rates rising? Is the economy in a recession? These factors can significantly impact market performance. For instance, during periods of economic uncertainty, investors tend to flock towards safer assets, potentially causing a dip in the stock market. Conversely, during periods of economic growth, the stock market tends to perform well. It's essential to stay informed about current market trends and economic indicators. By understanding the broader economic context, you can make more informed decisions about when to buy, sell, or hold your mutual fund investments. Remember, investing is a marathon, not a sprint. Stay focused on your long-term goals and don't let short-term market fluctuations derail your investment strategy. Let's dive into the world of mutual funds and break down their pros and cons. First up, diversification. Mutual funds are fantastic for spreading your risk. Instead of putting all your eggs in one basket, you invest in a basket of stocks or bonds. Think of it like this. If one stock in your portfolio takes a hit, the impact is cushioned by the performance of the other holdings. This diversification helps reduce volatility and potentially leads to more stable returns over time. Another major advantage is professional management. When you invest in a mutual fund, you're essentially hiring a team of experienced professionals to manage your money. These fund managers conduct extensive research, analyze market trends, and make investment decisions on your behalf. This can be a huge advantage, especially if you're new to investing or don't have the time to actively manage your portfolio. Now let's talk about the flip side: fees and expenses. While mutual funds offer numerous advantages, they don't come free. You'll typically encounter fees like expense ratios, which cover the costs of managing the fund. These fees might seem small, but they can eat into your returns over time, especially if you're investing for the long haul. Imagine a 1% annual fee on a $10,000 investment. That's $100 gone each year. Additionally, some mutual funds have loads, which are essentially sales charges. Front-end loads are charged when you buy shares, while back-end loads are charged when you sell. It's crucial to pay attention to these fees and factor them into your investment decisions. Look for funds with low expense ratios and avoid loads whenever possible. Mutual funds limit your control over stock selections. Fund managers make the decisions which might not align with your style. Research the fund's strategy to match your goals. Mutual funds can create taxable events. Consider tax implications, especially outside tax-advantaged accounts. That wraps up our Mutual Funds 101 guide. Hopefully you now have a solid understanding of what mutual funds are, how they work, and the crucial factors to consider before investing. Remember, investing is a journey, and mutual funds can be valuable tools to help you reach your financial goals. But just like with any investment, it's essential to do your research, understand the risks, and choose funds that align with your individual needs and risk tolerance. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more investing tips and guides. Leave a comment below if you have any questions or topics you'd like us to cover next. Don't forget to subscribe to the channel and hit the notification bell so you never miss out on any of our informative videos. And if you enjoyed this video, make sure to like, share, and leave a comment below. We'd love to hear from you.